Welcome back to The Deep Dive, the show where we take the source material defining complex financial, technological, and regulatory landscapes and distill it down to the essential knowledge you need to navigate the world.
Today, we are taking a profound step away from the public markets. We're leaving the daily fluctuations of stocks and general mutual funds behind and entering a highly specialized, exclusive domain.
A domain reserved for institutions and, high net worth individuals.
Exactly. This is the world of alternative investment funds, or AIFs, and we're looking at it specifically through the lens of the rigorous regulatory framework in India.
Okay, so let's unpack that. For most of us, when we think investing, we think liquidity, the ability to buy and sell, almost instantly. But alternative investments, they seem to operate on a completely different philosophy.
They do. They're complex, they often lack transparency, and crucially, they are defined by their illiquidity.
Which is precisely why the regulatory net, supervised by the Securities and Exchange Board of India, or SEBI, has to be so detailed and, frankly, so strict.
Precisely. Our mission today is to move past the glossy brochures that just say private equity offers high returns. I mean, everyone sort of knows that.
Right, that's the headline.
We want to drill into the regulatory architecture provided by our sources, the real plumbing of sophisticated finance. We want to extract the concrete numerical rules, the 1 crore minimum ticket, the 10% versus 25% concentration limits.
And the really important structural differences between the three mandated categories of AIFs.
Yes, this is the blueprint for how sophisticated capital actually flows in India.
So we're delivering the specific, actionable framework that defines this market, showing you exactly who's allowed to participate and the constraints they have to operate under.
Let's get into it.
Before we jump into SEBI's framework, we really need to solidify this core concept. When we use the word alternative, what is it alternative to?
Well, it's alternative to traditional investments, which are really the bedrock of the average investor's portfolio.
So we're talking about things like publicly traded stocks, bonds.
Stocks, corporate or government bonds, your standard mutual fund units, and exchange-traded funds, or ETFs. These assets cater to the general public, and they're aiming to provide returns that, outpace lower-risk savings options like a fixed bank deposit or even physical gold.
And the defining feature of all of those, as you said, is that high liquidity.
Yes. They are on-market opportunities. They trade on centralized exchanges or platforms, which allows for an immediate exit or redemption. You can sell your stock or redeem your ETF unit in a matter of hours, maybe days.
But the alternative side structurally embraces the complete opposite.
It does. Its essential defining characteristic is illiquidity.
Illiquidity meaning that converting the asset back into cash is neither quick nor easy. Why is that? What's the fundamental reason?
It's because the assets themselves are often off-market and just very complex. They involve direct investment in private companies or specialized real estate, complex debt instruments, infrastructure projects that require multi-year holding periods.
So there's no central stock exchange for a stake in a startup?
Not at all. These assets lack a standardized trading venue and a rapid redemption mechanism. And this inherent structure means alternatives can really only cater to sophisticated investors. Pension funds, insurance companies, family offices, and HNIs.
Entities that manage huge pools of money and, more importantly, have long-term time horizon and high-risk capacity to weather a multi-year lock-in.
That's the key. They can afford to be patient.
So strategically, the role of these alternative assets isn't just about chasing higher returns, is it?
No, not at all. It's about portfolio science. It's about complementarity. Sophisticated investors use alternatives to complement their traditional liquid portfolios. The strategic objective is to improve the portfolio's risk-adjusted returns over the long haul.
So you accept the complexity and the lack of an immediate exit.
Knowing that the returns are often uncorrelated with the volatility of the public stock and bond markets, this provides a critical source of diversification and stability, especially during times of broader economic stress.
It sounds like illiquidity, in this context, functions less as a drawback and more as a feature. It almost forces investor discipline and screens out anyone who might panic sell based on short-term market noise.
That is precisely the regulatory and strategic thinking behind it. It mandates patience.
Okay, let's focus specifically on how this market evolved within India, because the story isn't exactly linear. Our sources show the seeds were planted decades ago. Where did the initial push come from?
The evolution started remarkably early, back in the 1980s, and it was centered around the initial concept of venture capital financing.
But not like the Silicon Valley model we think of today.
No, not at all. Unlike that tech-driven individual investor model, the early Indian movement was driven by institutional, almost public sector entities. We're talking state-level industrial development corporations, major financial institutions, public sector banks. It was capital mobilization, but it was often publicly steered.
So how did SEBI transition this early institutionalized capital into the formalized private capital market we see today?
The pivotal moment was the 1996 SEBI Venture Capital Fund regulations. This was crucial for formalizing the field. These regulations moved away from focusing only on untried technologies, and, most importantly, they brought the flow of private capital into unlisted companies under the official structured rules of institutional investment.
It standardized the whole process.
It did. It moved it from ad hoc financing into a regulated structure.
And that formality was, it turned out, perfectly timed to capture the global tech wave.
Absolutely. The dot-com boom of 1997 to 2001 fueled the rise of numerous VCFs in India, explicitly mirroring that Silicon Valley model of rapid funding for tech startups. After 2001, private equity just descended aggressively.
Right. Our sources show a massive expansion leading up to 2007, where private capital was funding everything from manufacturing and real estate to logistics and banking.
And that rapid expansion created enormous systemic risk, particularly around liquidity, and that risk exploded into reality with the 2008 global financial crisis.
So how did that crisis specifically impact this young, burgeoning Indian private capital market? And how did that fallout inform the rules we're discussing today?
Well, the 2008 crisis severely curtailed capital markets everywhere, and India was no exception. For AIFs, the biggest pain point was exits.
Getting their money out.
Exactly. Because the assets were private and illiquid, funds struggled desperately to sell their holdings. IPOs, strategic acquisitions, they just dried up completely. Investors were locked in, returns plummeted, and that initial growth was effectively halted.
What a shock to the system.
A huge one. And the experience highlighted the acute danger of illiquidity when it's coupled with weak capital markets. SEBI learned a hard lesson from that. If you facilitate the flow of illiquid capital, you have to enforce stringent structural requirements to manage that risk. And that leads us directly to the rules that were formalized later.
Okay, so understanding that history of liquidity shock and, frankly, some reckless expansion, SEBI formalized the rules of engagement. What is the fundamental, non-negotiable SEBI definition of an AIF?
The definition is the structural foundation. An AIF is a privately pooled investment vehicle that collects funds from investors, domestic or international, following a defined investment policy.
And the key phrase there is privately pooled. What does that mean in practice?
It means the general public cannot participate. The capital is collected from a select, specific group of sophisticated investors. This ensures that the typical retail investor who lacks the risk capacity or understanding of these illiquid structures is protected.
And that protection is enforced through some very strict numerical limits. Let's start with the hard requirements for the scheme itself.
Okay, first, the fund size. Each AIF scheme must have a minimum corpus, a fund size of at least 20 crores.
20 crores, okay. So about $2.5 million US dollars.
Roughly, yes. This ensures the AIF is professionally managed and operates at a scale that justifies the regulatory overhead. Second, the pool of investors is capped. A fund is limited to a maximum of 1,000 investors per scheme.
And for the individual HNI trying to get access, what is the ultimate financial barrier?
The ultimate filter is the standard minimum investment. An AIF cannot accept anything less than 1 crore rupees from any single investor.
1 crore. That's about 120,000 US dollars. That is the mandatory minimum ticket size.
It is. It establishes the financial sophistication floor required for entry.
Now that 1 crore is the default, but our sources detail a very important exception.
Yes, an exception that allows for alignment of interest without that massive cash requirement.
And this is for the team running the fund, right?
Exactly. Employees or directors of the AIF or its manager are allowed a significantly lower minimum investment of 25 lakh rupees.
So a quarter of the standard amount.
Yes, and this is a strategic move by SEBI. It ensures that the people making the investment decisions can also participate meaningfully in the fund's performance, aligning their personal financial interest with the collective success of the fund.
Right, without mandating that they personally have to meet that very high H&I threshold.
Correct. It's about alignment.
That concept of aligning interests is clearly paramount to SEBI. They use this continuing interest requirement, what we'd call skin in the game, to make sure the fund management is truly committed.
And this rule is a foundational mechanism for fiduciary duty. The sponsor or manager must maintain a committed investment in the scheme, and crucially, this must be an actual investment of capital.
So they can't just waive their management fees to satisfy this.
No, absolutely not. It has to be tangible capital exposure, forcing them to share in the risk of the fund's performance.
The required commitment varies based on the inherent risk of the AIF category, doesn't it? What are the requirements for Category 1 and Category 2 AIFs?
For Category 1, which is focused on socially desirable sectors, and Category 2, your standard private equity or debt funds, the requirement is not less than 2.5% of the fund's corpus or 5 crore rupees, whichever is lower.
And that whichever's lower part is important. The cap at 5 crore keeps the financial commitment reasonable even for a massive fund.
It does. But for the high-risk category, Category 3, which uses leverage, the bar is much higher.
As it should be.
Absolutely. Because Category 3 AIFs use leverage and complex trading strategies, multiplying both potential returns and potential losses. SEBI mandates a higher managerial commitment. The continuing interest for them is at least 5% of the corpus, or 10 crore rupees, whichever is lower.
So double the percentage and double the cap. It really reflects the heightened need for accountability when you're playing with borrowed money.
It's all about risk sharing.
We've established that standard 1 crore minimum, but there's a specialized status that allows entry at that lower 25 lakh ticket size, designed to formally recognize those who are financially sophisticated. That's the accredited investor status.
This is SEBI's formal acknowledgement that sophistication isn't just defined by the size of your initial check, but by verified substantial financial capacity and experience. Once you're accredited, an investor gains access at that lower 25 lakh minimum.
The criteria for an individual to achieve this status are incredibly detailed. Let's look at the 3 pathways to accreditation.
Right, you only need to meet one of these 3 thresholds. The first pathway is pretty straightforward, an annual income of at least 2 crore rupees.
Okay.
The second pathway is a mix of income and net worth. An annual income of 1 crore combined with a net worth of at least 5 crore. And critically, 3.75 crore of that net worth must be in financial assets.
And the third path?
The third pathway focuses solely on net worth. A minimum net worth of 7.5 crore, with that same 3.75 crore mandated to be in financial assets.
So SEBI is explicitly excluding non-liquid assets, like your primary home or expensive art, from being the main basis for accreditation. Why the focus on financial assets?
It's a measure of deployable capital and financial engagement. Owning a large, expensive home doesn't necessarily mean you understand or can tolerate the risks of illiquid venture capital. SIPI wants to see wealth held in financial instruments.
And for a corporation.
For a body corporate, the criteria are simpler but massive. They must have a net worth greater than or equal to 50 crore rupees to qualify.
Given the nature of these funds, large pools of capital investing in private companies, there's a massive danger of concentration risk. Betting too much of the fund on a single company. SEBI uses concentration limits to manage this.
This is fundamental regulatory risk management. It's designed to force diversification. The limits dictate the maximum percentage of investable funds an AIF can place in a single investee company, and they are tiered according to the fund's risk profile.
Okay, so what are those specific limits?
For Category 1 and Category 2 AIFs, the unleveraged lower risk groups, the limit is that they shall invest not more than 25% of their investable funds in a single entity.
A quarter of the fund in one company. That's still a big bet.
It is. But for the high-risk, leverage-using Category 3 AIFs, the restriction is far, far tighter. They can't invest more than 10% of their investable funds in a single investee company.
Wow. That 10% versus 25% difference is hugely instructive. The regulator's basically saying, if you're going to amplify risk with leverage, you have to amplify your diversification to counteract it.
Absolutely. The leverage used in Category 3 magnifies any loss from concentration. A 10% ceiling ensures a single catastrophic investment won't decimate the fund.
What about the money that the AIF has collected but hasn't invested yet, the uninvested portion?
The rules mandate absolute safety and liquidity for that capital. It must be strictly placed in highly secured instruments. Liquid mutual funds, bank deposits, or top-tier liquid assets like treasury bills and commercial papers.
So no parking it in anything speculative while waiting for the next deal.
No loopholes. It reinforces the fiduciary duty to protect that capital.
Yeah.
And finally, there's the co-investment rule.
Another layer of scrutiny on the fund manager?
Yes. If a sponsor or manager decides to personally co-invest alongside the AIF in one of the portfolio companies, SEBI mandates fairness. Their co-investment terms cannot be more favorable than those offered to the AIF itself. It's a crucial defense against self-dealing.
It really is a comprehensive framework. SEBI has anticipated nearly every major systemic risk point and built a numerical fence around it.
It creates a sophisticated, rules-based ecosystem that fosters confidence among large institutional investors.
Now we move to the three primary buckets of AIS. Our sources provide a highly effective, memorable analogy to quickly distinguish their intent and strategy.
Yes, this analogy is a great mental shortcut for understanding the regulatory intent behind each category.
So we have Category 1 AIFs, which are like the community garden,
Then Category 2 AIFs, which are like the private estate.
and Category 3 AIFs, which are like the high-stakes casino. If you keep those three settings in mind, incentives, stability, and leverage, the subsequent rules make perfect sense.
They really do.
Let's start with the community garden, Category 1. In this analogy, the government is tending the garden, encouraging specific growth. What defines this category?
These funds are defined by their mandate to invest in sectors deemed socially or economically desirable by the government or regulators. The intention is to channel patient capital into areas of national strategic priority, things like early-stage tech, infrastructure, or supporting small businesses.
And what's the mechanism used to incentivize managers and investors to prioritize these sectors?
The key differentiating factor is the incentives. These funds typically receive special benefits from the government or regulators. This might be beneficial tax treatment, streamlined approvals, or other forms of support.
What types of funds fall under this umbrella?
This is where we find venture capital funds, SME funds, social venture funds, infrastructure funds, and special situation funds. Their focus is specifically on foundational and often early-stage ventures.
Moving on to the private estate, Category 2. This sounds like the core standard private investment vehicle.
It is the default or residual category. It's defined by what it is not. It includes funds that don't get the special incentives of Category 1 and, crucially, do not use the complex strategies or leverage of Category 3.
So what's the fundamental rule regarding borrowing?
The defining rule for Category 2 is the leverage rule. They do not undertake leverage or borrowing except for minimal operational borrowing for day-to-day needs. They are unleveraged, long-term holders of capital.
And since they're not focused on a government priority, they don't get special treatment.
Correct. No specific government incentives are attached. This is the home of your traditional large-scale private equity funds and standard debt funds.
Finally, the high-stakes casino, Category 3. The risk profile shifts dramatically here.
It does. This category is defined by the highly active, complex nature of its strategy. These funds employ diverse, often arbitrage-based or complex trading strategies, and this category is permitted to employ leverage.
And they use derivatives.
Frequently, they use investment in listed or unlisted derivatives to amplify returns. The intent here is shorter-term returns, using market volatility rather than long-term asset development.
So this is where we find hedge funds.
Precisely. This is where you find hedge funds and funds focused on generating short-term trading profits. The core insight is that the use of leverage and derivatives is the regulatory fingerprint of Category 3, which necessitates those higher managerial commitments and tighter concentration limits we talked about earlier.
It's a fantastic regulatory segmentation. SEBI has clearly tiered the market based on risk and public benefit.
It allows institutional capital to access the full spectrum of investment strategies, all within a predictable, highly constrained framework.
Now that we have the three categories, let's look inside and see the specific investment vehicles these AIFs use. This is the toolkit of sophisticated finance.
We should begin with the vehicle that really started it all in India, the Venture Capital Fund, or VCF. This AIF invests predominantly in unlisted securities of startups or emerging units involved in novel products, services, or technology.
So VCFs are focused on that initial spark, the earliest phase of an idea coming to market. How does that contrast with a standard private equity fund?
It's all about the stage of the corporate life cycle. A VCF is in the garage phase, funding proof of concept. A PE fund, on the other hand, is involved in later stage financing. They invest in businesses that are already established but need significant capital to scale up to the next level.
So PE is about growth optimization. VCF is about inception risk.
A perfect summary. And within the VCF structure, we have the highly specialized angel fund, which imposes very specific criteria not just on the money, but on the wisdom of the investor.
Right, these are a subcategory of VCFs under Category 1.
Yes, and SEBI defines who qualifies as an angel investor with extraordinary rigor. to make sure the capital is truly smart money.
Let's break down those requirements for an individual angel investor. They're about more than just wealth.
First, the financial hurdle. The individual must have net tangible assets of at least 2 crore rupees, and that explicitly excludes the value of their primary residence. Second, the experience test. The individual has to have verifiable experience in one of 3 areas:
Sure.
a proven track record of early-stage investing, experience as a serial entrepreneur, or having served a minimum of 10 years as a senior management professional.
That experience requirement is key. The regulator views the angel investor not just as a source of capital, but as a potential mentor, an experience guide.
Absolutely. The intent is to connect vulnerable early-stage ventures with expertise, not just liquidity.
Shifting to the debt side of the market, we have the debt fund. Why is debt considered alternative when government bonds are so traditional?
Again, it comes down to complexity, structure, and illiquidity. A debt fund invests primarily in debt or debt securities of listed or often unlisted investee companies. This debt is typically customized, negotiated privately, and lacks a public trading exchange.
So it's not something you can just sell on the open market.
Not at all. And the sources detail several specific subtypes. For example, mezzanine financing.
What is that exactly?
It's a hybrid instrument. It's essentially debt capital that carries an equity upside. For example, the loan might come with warrants attached, giving the lender the right to convert a portion of the debt into equity if the company hits certain targets.
And then there's the highly strategic area of distressed debt financing. This capital enters the market at a company's lowest point.
Distressed debt funds are specialists in crisis management. They provide capital to companies with heavy debt burdens, aiming for either a turnaround or an acquisition through insolvency proceedings. This entire field is directly governed by the legal machinery of the Insolvency and Bankruptcy Code, 2016.
That's a critical legal link. These funds aren't just financiers. They are using a specific high-stakes legal framework.
Precisely. They are acting as strategic players in corporate restructuring. And then you have infrastructure funds, which require extreme patience.
Right, funding things like roads, ports, energy.
Yes, and while they're vital, they carry massive, well-known risks. High illiquidity, long gestation risk. It can take a decade or more to see a return.
The versatility of the AIF structure allows for even more niche targeting. What other specialized funds complete this toolkit?
Well, we have the SME fund, which focuses specifically on small and medium enterprises. Then there's the poster child of Category 3, the hedge fund.
The classic Cat 3 player.
Right. Employing complex, often aggressive trading strategies, using derivatives, trading diverse risks. We also see the AIF structure used for social priorities through the Social Impact Fund.
So investing in things like charitable trusts or microfinance institutions.
Yes, where the investment goal is dual: a financial return running parallel to a demonstrable social welfare metric. And finally, returning to the IBC, the Special Situations Fund.
Which has a very specific, aggressive role.
It does. They have the regulatory capacity to act as a resolution applicant under the IBC. This means they are positioned to acquire, restructure, and potentially revitalize distressed companies by proposing a formal resolution plan. It's a high-risk, high-return play on corporate turnaround.
When you look at this entire toolkit, from funding a startup in a garage to acquiring a bankrupt factory, it's clear the AIF structure provides the vehicle to channel sophisticated capital into every corner of the economy that public markets can't reach.
It is the ultimate expression of financial engineering designed for scale and complexity.
Now that we understand the structure, let's look at the strategy employed by the fund managers. For those overseeing these massive, illiquid portfolios, strategy can't be static, can it?
Absolutely not. The AIF environment is constantly changing. Managers are under continuous pressure to meet improving return expectations while navigating technological innovations, new regulations, and extreme economic volatility.
And global macroeconomics heavily dictates where this capital finds a home.
We've seen a clear pattern. Prolonged expansionary monetary policies and low interest rates in, mature Western economies have driven returns down there. Consequently, massive pools of institutional capital are shifting their focus to high-growth emerging markets like India, searching for the yield and diversification that AIFs often provide.
It's vital to remember that AIFs are not simply an attempt to win big. Their primary role is often defensive, right? It's about portfolio construction.
That is the core rationale. While the potential for outsized returns exists, the fundamental benefit is their value in diversification and risk management. Because their performance correlation with public markets is low, they provide essential stability when traditional assets are under stress.
We've covered concentration risk and SEBI's hard limits. But risk management has to begin at the investor level, formalized in a governing document.
That document is the Investment Policy Statement, or IPS. For every sophisticated client, the IPS is mandatory. It's the roadmap that formally documents the investor's precise risk appetite and clearly defines their objectives and constraints.
And those objectives are increasingly moving beyond pure financial metrics. Investors bring personal beliefs and values into the equation, which the sources call idiosyncratic concerns.
Idiosyncratic concerns are personal, social, ethical, or cultural beliefs that directly influence an investor's preferences. This has massive implications today, especially with the surge in awareness around sustainability and ethics.
Let's elaborate on the distinction the sources draw between sustainable investing and ethical investing. The terms are often used interchangeably, but they're different.
They are. Sustainable investing operates on a broad framework, primarily focusing on environmental, social, and governance, or ESG, criteria. It's typically about positive screening, actively seeking out companies that demonstrate superior performance in these metrics.
Ethical investing, on the other hand, is much more rigid and personal.
Correct. Ethical investing is driven by specific moral principles. It usually employs negative screening. For example, an investor might strictly and explicitly screen out all companies involved in alcohol, tobacco, gambling, or firearms, so-called sin stocks, regardless of how well they perform on broader ESG metrics.
An investor's life stage also fundamentally impacts their capacity for risk. Our sources define strategic phases, starting with the accumulation phase.
The accumulation phase is typically during an investor's early to mid-career. Their net worth is small compared to long-term liabilities, but they have a massive asset time. They have a long investment horizon.
So they're best suited to tolerate the high risks and multi-year lockups of AIFs.
Exactly. Time is the shock absorber. And at the far end of the life cycle, we find the gifting phase. This is where assets far exceed needs, and the focus shifts to legacy planning, charity, and wealth transfer.
Within their strategy, fund managers make two key types of allocation decisions. What's the distinction between strategic asset allocation, SAA, and tactical asset allocation, TA?
SAA is the foundational long-term decision. It is the core portfolio design built to meet the investor's goals over a long time frame. It's the portfolio's anchor. TAA, on the other hand, is a short-term maneuver.
So shifting money around to exploit a market opportunity.
Exactly. A temporary shift to take advantage of some market discrepancy.
But how does the illiquidity of AIFs complicate implementing that kind of tactical move?
This is where the strategic rubber meets the operational road. Illiquidity is the greatest operational constraint. If an AIF manager decides to execute a TAA, say, shifting away from infrastructure debt, the illiquid nature of the asset makes the execution slow, complex, and significantly more costly.
There's no simple market to just offload a partnership interest in a toll road.
Not at all. The higher transaction costs and the time delay make TAA a far less nimble and more expensive option for AIFs. Illiquidity imposes a forced discipline, making that long-term SAA paramount.
The AIF market is defined by high financial value and intricate regulation. So operational compliance, due diligence, and accountability must be intense. Let's look at the specific requirements, starting with the investment advisor.
The investment advisor, or IA, acts as the fiduciary guide, and SEBI imposes strict transparency and record-keeping mandates. First, the IA must clearly define their scale of operation by calculating their assets under advice.
And there's a non-negotiable rule for transparency about conflicts of interest.
This is absolutely mandatory. An IA must explicitly disclose to the client their personal position or holding in any securities they recommend. This is to prevent an IA from pushing a product primarily because they have a personal financial stake in its success.
What if the IA is recommending something that falls outside SEBI's direct regulatory net?
This is a crucial safety disclosure. If the IA recommends a product outside SEBI's direct purview, they must explicitly disclose that no SEBI recourse is available for investor grievances. This formally shifts the risk onto the sophisticated client.
And how long do they have to keep records?
The IA must maintain all AIF-related records, communications, agreements, everything, for a minimum period of 5 years. This ensures a robust, auditable trail.
Let's look at the mechanics of how an investor's holding is managed. Physical documentation must be obsolete for this kind of thing.
It is. AIF units are overwhelmingly required to be held in dematerialized or DMAT form. This aligns the AIF market with modern depository practices, ensuring standardized record-keeping and enhanced security.
In sophisticated wealth management, the power of attorney, or POA, is common. What are the rules around that?
A POA grants a third party the ability to handle the investor's affairs. While it's useful, the sources emphasize a strict limitation. A POA holder cannot appoint a nominee for the investment. That right must remain with the primary investor.
And finally, verifying the identity of the investor is a mandatory, non-negotiable step.
That's right. The in-person verification, or IPV, is mandatory. However, compliance has adapted to technology. SEBI now authorizes video in-person verification, or VIPV, conducted through authorized apps.
So they could do this over video now. That's a big deal.
It is. It streamlines the onboarding process for HNIs and institutions who might be geographically dispersed, allowing the market to maintain strict KYC norms without requiring physical presence. It ensures operational integrity is maintained.
This deep dive has mapped out the engine room of India's alternative investment structure. To synthesize, what are the core structural distinctions we must internalize?
I think the central distinction is that AIFs are high-risk, high-reward vehicles defined by illiquidity, and they're strictly gated for sophisticated investors. They exist entirely outside the structure and safety mechanisms of traditional public markets.
And if we had to distill the regulatory landscape down to the absolute must-know numbers for the listener, what are the key data points?
Remember the financial barriers. The standard individual entry point is 1 crore rupees, with that key exception for accredited investors and internal staff at 25 lakh. And remember the core structural difference. Category 1 funds are defined by incentives, while Category 3 funds are defined by their use of leverage, which leads to those stricter diversification limits.
The incredible depth and diversity of the AIF toolkit, from VCFs and infrastructure to distressed debt resolution and social impact funds, confirms that this structure is the necessary bridge, allowing investors to strategically target economic niches the general public's capital can't reach.
It's the regulated pathway for patient, sophisticated capital to engage directly with the complex, long-term needs of a developing economy.
That leads us back to a strategic tension we discussed. AIFs are long-term illiquid commitments designed for patience. But we also saw the rapid acceleration of investor demands around ESG and personal ethical investing.
Yes, the underlying assets are locked up for years, making any strategic shift slow and costly.
So here is the question for you to consider. Given this rapid shift towards sustainable and ethical investing, where market pressure might suddenly require managers to divest from, say, a carbon-heavy sector, how does the inherent difficulty of exiting and restructuring those illiquid 10-year AIF portfolios impact a manager's fiduciary duty?
It's a huge question. Are AIF managers structurally resistant or perhaps even unable to respond quickly to the rapidly evolving social and ethical demands of their investors?
That tension, the friction between the long-term rigid commitment of capital and the short-term dynamic evolution of ethical values creates a major strategic dilemma.
It does. Managers have to structure their investments today to anticipate potential ethical red lines that may only emerge 5 years into a 10-year lockup period. It is arguably the most significant non-financial risk factor facing alternative investment management today.
A perfect note to end on. Thank you for joining us for the deep dive. We hope this exploration has fully equipped you with the concepts and the crucial regulatory framework necessary to understand the sophisticated world of alternative investment funds.